Hello everyone and welcome to the TradeNeon YouTube channel. The Fed has a new chair, and this is not a routine change that we can simply wave through. Jerome Powell is out of the chair seat after 8 years. His successor is Kevin Warsh, confirmed on May 13 with 54 to 45 votes. By the way, that was the narrowest vote for a chair ever. This is exactly where things get interesting for us as traders, because this transition is anything but business as usual. What this means in practice for us as swing traders and day traders is what we're going to look at now. Let's get started after the intro. First, a quick look at the setup. Powell had been in office since 2018. Interestingly, Trump nominated him himself in 2018 and then publicly attacked him for years, keyword too late Powell. There was even a DOJ investigation into the renovation costs of the Fed headquarters, which was later withdrawn. The past few months were pure political pressure and certainly not a pleasant time for Powell. Powell stepped down from his chair position on May 15th, but remains on the board as governor until 2028. That is actually a historic detail. The last time a Fed chair continued as a regular governor was almost 80 years ago. Powell therefore keeps a vote on the FOMC. Sounds like a detail, but it is important. More on that in a moment. So, who is this Kevin Warsh? Warsh already served as a Fed governor from 2006 to 11, so he went straight through the financial crisis. Since then, he has openly criticized the Fed, especially QE, which he called reverse Robin Hood. QE, quantitative easing, means the Fed buys treasury bonds and mortgage-backed securities in the open market, pays for them with newly created reserves, and thereby pushes long-term interest rates lower while pumping liquidity into the system. In short, the tool that grew the Fed's balance sheet from $800 billion before 2008 to almost $9 trillion at one point. Warsh's criticism of it has two sides. First, reverse Robin Hood. QE primarily inflates asset prices and therefore benefits those who own stocks and real estate, while savers and wage earners lose purchasing power through inflation. Second, misallocation. When the Fed artificially suppresses yields, the bond market loses its disciplinary function, the Fed put becomes a crutch, and the system becomes addicted to liquidity. There are three things you should know about Warsh. First, he is hawkish on the balance sheet side. That means he wants to shrink the Fed's balance sheet faster. More QT, less QE. Second, he is more flexible on interest rates. At first, that sounds dovish, but it is tricky, because he is coming into a Fed that is becoming more hawkish, not more dovish. Third, in the Senate hearing, he literally spoke of a good family fight over monetary policy. That points to a communication style that has very little in common with Powell's approach. Now let's look at the macro setup Warsh is stepping into. And it is anything but relaxed. Inflation, April CPI at 3.8%, highest level since May 2023. Core inflation stuck at 3.5%. Labor market, non-farm payrolls at 115K in April. Unemployment rate at 4.3%. Solid but not hot. Geopolitics, the Iran conflict has been running for 11 weeks. The Strait of Hormuz is closed, Brent above $100. And the bond market, 30-year Treasury yield at 5.12%, highest level since 2007, 10-year at 4.59%. The bond market has de facto already priced in a rate hike before Warsh even holds his first meeting. Market probability for an interest rate change on June 16th and 17th, according to CME FedWatch, over 97% for no change. This will not be an action meeting in terms of the rate decision, but, and this is the key point, the meeting will still be highly volatile. Why? First, it is an SEP meeting. New dot plot, new economic projections. This is Warsh's first real positioning moment. Second, press conference. First time Warsh at the microphone as chair. Every word will be interpreted, every pause analyzed. Third, the dissent picture. In the April meeting, we already had 3 dissenters against the statement. If Warsh tries to communicate more dovishly than the committee wants, we may get one story at the press conference and a different story in the minutes 3 weeks later. Exactly that gap may become tradable. So, what does this mean for you specifically? For the swing traders among you, 3 points. First, expect ongoing bond volatility. If the 10-year moves toward 4.8%, that has almost always been a tipping point for the indices in recent years. Above that, things get tight for growth. Below that, the market can breathe again. Second, sector rotation is already underway. Energy up 30% year to date, AI and growth names under pressure. Valuations at 24 times forward earnings versus a historical average of 19 times. In an environment like this, quality plus dividends make more sense than hot momentum. This is a good time to reorganize your watch lists. Third, the dollar. If Warsh sounds more dovish than the committee, the dollar comes under pressure. Good for commodities, good for emerging markets, good for gold. If he pulls the committee with him, meaning he comes across more hawkish than expected, the trade reverses. So we should keep an eye on DXY and gold in parallel. For the day traders, also 3 points. First, the minutes from the last Powell meeting have been out since May 20. That is where you can see the dissent map. Who argued how? If you have not read it yet, catch up on it because it is a good setup preparation for the next few weeks. Second, June 17th, press conference at 2:30 Eastern. If you have never heard Warsh live before, first wait for the statement and dot plot, observe the reaction in the first few minutes, and only then decide how you want to behave. Powell press conferences were often mean reverting. With Warsh, we simply do not know yet. First press conferences of new chairs have historically been more volatile. Greenspan in 87, Powell in 18, both came with larger daily moves than the median FOMC day. Third, watch the expected move. Look at where the implied move on the SPX straddle for the FOMC day is compared with the realized move of the last 12 FOMCs. If implied is significantly above realized, there is premium to sell. If implied is below it, there is cheap gamma to buy, a classic vol setup. Final take. We are not heading into a calm phase. The next 6 months will be shaped by a new chair who does not yet know how he wants to communicate, a committee that is more hawkish than the chair, inflation that refuses to come down, and a bond market that is already tightening the reins. For us as traders, that means more volatility, maybe better setups, but also more potential false moves. Risk management will be more important than edge optimization over the next months. Better to trade smaller size across more setups than go all in on one scenario. If this video helped you, feel free to leave us a thumbs up and subscribe to the channel. Our level of interest software helps you not only to keep a close eye on the daily expected move, but also get many other data points and metrics from us at a glance every single day. Try the software for free for 7 days now. You can find more information at TradeNeon.com. See you next time. Take care.